5-star copies all. Go ahead. Message to observer. Alpha 3 rounds. AT delay in effect. 3 guns. Bravo 2 rounds. 2 guns. Smoke on effect.
Hey, what's up, y'all? This is Andrew from the OM community. Thanks for watching. This video is going to be for beginners or anyone else who is struggling to find consistency when trading options, stocks, or futures. I've been trading the market for 12 years, both on the long-term investing side and the day trading side, and I attribute all of my success to these very basic 5 foundational rules that I think will greatly enhance your ability to give profits month after month. And before we get started, I appreciate if you hit that like and subscribe button. It helps the community grow so other people can learn how to trade successfully and profitably over the long haul. Getting started with the number 1 rule, and in my opinion, the most important, position sizing. Position sizing is very important for a multitude of reasons. The first of which is enables you to control your losses. If you can't control your losses, you're never going to be able to get on the right track to profitability. I don't care how good your system is. Your losses will always be bigger than your wins. You'll have 2 steps forward, 5 steps back, 3 steps forward, 3 steps back, 1 step forward, 4 steps back, etc., etc. The second reason is it enables you to control your emotions. In my opinion, controlling your emotions or the psychological aspect of trading is the most important part of trading. In fact, it's 99% of trading. It's very easy to figure out the technical side of trading, but managing the human nature in your head, the psychological part, the emotional part, especially when things go wrong, is incredibly, incredibly difficult. That's why there's only a few number of people that are able to be successful, because only a few number of people are able to master their mind in trading. The third benefit to position sizing is being able to stay in a trade longer. Now, this is not something that traders normally think of, but it's very much true. I'm willing to bet that you're not as bad a trader as you think you are. You just don't give yourself enough time in the trade. You are so incredibly overexposed to position sizing that you're unable to weather any kind of drawdown. Let's say you're a trader here and you elected to take a long here because we're at the base of the demand, but unfortunately you take a very large position sizing. We get a liquidity sweep lower, most likely you freak out, you lose a lot of money, and you exit the position for a pretty healthy loss. Another trader who does smart position sizing would take a very good long down here because we are at the base of demand, and you're able to weather the liquidity sweep. We have 1 quick candle lower to stop people out, and we start to move back higher. You're just fine and dandy, haven't been able to absorb 1 little candle of drawdown, and you're in a good solid position. And now you're able to hold it for a couple of hours instead of just a couple of minutes. Do yourself a favor and buy yourself some more time in the trade. The final benefit of position sizing is to simply just survive. Now, this kind of goes in line with number 1 of controlling your losses. In the game of trading, it's all about survival. It's not about how much you make, it's about how much you can keep, because losses are sneaking up on you at every second of every day around every corner. So make sure you're controlling your position sizes so you can survive the long haul. Rule number 2, reduce your trading frequency. Far too many traders think there's opportunity at every single moment, at every single day, on every single name in the stock market. What I would rather you do is pick out 5 or 6 names in the market to monitor consistently, and then on those 5 or 6 names, pick out major pivots of demand and resistance at those areas, and simply wait to trade at those levels. It could take you 3 or 4 days to even take a single trade, or you could take 5 trades in a single day if they all hit at once. It depends on the system, but I would much rather you pick out spots of significant action on the charts and only trade there than sit there and simply react to every whim and movement in the market. Maybe it's as simple as plotting macro rejections like this, or minor bounces like this. Either way, have a plan of attack and wait for those plans. Don't just simply mark an entry into every candle. Number 3 is keep it simple, stupid. We've all heard that acronym KISS, K-I-S-S. It's absolutely true. Reduce the number of indicators on your chart and understand what price action is first. Far too many times I see those crazy memes of indicators all over the place where you got lines and boxes and shapes and Fibonacci's and all this stuff all over your chart because it looks cool and you don't really know, so you're going to have something on the chart tell you what to do. Delete all this crap. I would encourage you to delete all of it. And instead, what I want you to do is start every day with a nice, fresh, clean chart and learn how to trade price action with volume. Learn price action candles and what they mean to understand that all this is right here. The hamster on the wheel behind this screen right here is simply liquidity. It's an auction of liquidity. Buyers and sellers bidding and selling to move the price. The market is going to buy at value and sell at premium. Sell at premium, buy at value. First, understanding that is absolutely paramount. And then once you do understand price action, you could start to trickle in a couple of high confidence indicators. But first and foremost is remove all the crap, cut the fat, and keep it simple. And rule number 4 is to define your trade ahead of time. You need to know exactly why you get in every single trade. You need to know what you're going to be looking for and what you're going to do when the price action gets there. When you take entry, you need to be able to exactly identify your risk, meaning where are you going to get out of the trade? How much money are you going to risk on any position? For example, if you are looking to go long here, and you do go long on this daily chart, you need to tell yourself, okay, I'm going to get out here or wherever it is. Conversely, on the upside, you need to see when you need to start scaling out of profit and looking for signs of rejection on any play like this. So let's say, all right, well, I'm going to start scaling out of the position here. I'm going to take some profit. I'm going to take my second leg of profit. I'm going to take my third leg of profit. Or if you're someone who doesn't even want to be in the trade that long, then you can just close out the position right here. Or what I like to do is move up a stop loss right here, a trailing stop loss the entire way until it trips and gets me out of the position. But I know when I'm going to get out of every single one of my trades. But you need to make sure you know the whys and whens of every single one of your exits and entries. And rule number 5, which is a bonus rule, is to have a backup plan. My backup plan is a long-term trading account. I don't care if you're 15, 16, 17 years old, 20 years old, 50 years old, 70 years old. Have a backup plan. Start putting money in the stock market right meow. I don't care if it's 1 share a week, 1 share a month, 1 share a quarter, 1 share a year, whatever you could swing, start putting money in the stock market now and forget about it. I have a long-term trading account and a day trading account. They are completely different, 100% separate. They don't touch each other. Most of my investing wealth is tied up in my long-term trading account in the form of stock holdings, the S&P, the QQQ, the VOO, REITs, the big S&P stocks, speculative stocks, and everything in between, because that keeps me safe. If I happen to miss a big bullish move in my day trading account, guess what? I'm good to go because I'm holding long-term holds for 20, 30, 40 years, and I'm never going to touch them. That is absolutely paramount for long-term growth. You cannot rely on your sole investing wealth in a day trading portfolio. You have to have a long-term port as your safety net and a small portion in your day trading for doing this style of short-term trading. That rule is non-negotiable. You got to do it. Anyway, that's all I got for you. I hope you enjoyed this video. A couple of quick tips for the beginner or the struggling investor. I guarantee you if you implement these trades, no matter what system you trade, you'll start to see profits and start to see consistency in your system over the long haul. I appreciate you taking the time to watch this video. Please like and subscribe. Come along and follow and join the community. We have a great Discord server where we talk about a lot of this stuff every single day, plus everyday live streams. I appreciate you taking the time to watch this video. Until next time, I'm out. See ya!